Welcome to our second quarterly call for 2015. We have muted all the phone lines, and Peter O'Keefe and Justin Stevens have the microphone. Just so you know, this call is being recorded. Before we get started, we must remind you that the purpose of today's call is educational and that the material presented is publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice. Furthermore, this presentation is not intended to provide specific advice to any individual's personal circumstances. You should consult with your accountant, attorney, or financial advisor based on your own individual situation. We discussed the purpose of the quarterly call in our spring 2015 Value Connection newsletter. We intend to host these calls each quarter to provide you with another avenue for education. We want to spend time explaining our approach to investing, financial planning, and behavioral coaching. These calls are recorded for playback at a future date, and we want to follow a consistent format so that these calls can become part of a user-friendly library of content that you have available for your reference. This call will begin with a broad economic update to build a frame of where we are today. We will quickly go over some of the U.S. and world issues that we faced over the last 3 months and give you our perspective on where this has created opportunity. Next, we will highlight some changes that happened this quarter. This quarter, we do not have any specific financial planning deadlines to discuss, so instead, we'll focus on some dividend increases that occurred and discuss why this is a critical element to long-term investing. Each quarter, we want to review the O'Keefe and Stevens team investment philosophy and discuss an investment that we own that fits those criteria. This quarter, we will be discussing Lowe's Corporation, which we own in many of our client accounts. Please note, this is not a recommendation to purchase Lowe's at this time, and with every investment, you should consult with your financial advisor to review suitability for your individual situation. And then the purpose of doing a review of a different investment each quarter is to reinforce our philosophy with you. The archive calls will become a useful tool for reviewing your holdings, and as this content library that we're creating grows, you're going to have access to many different investment reviews for the securities that you may own in your portfolio. The second half of our call today is designed to be interactive. We are going to review 3 questions that were submitted prior to this call from our existing clients. Our thought is that you will benefit from hearing the answers to questions that other clients are asking. We invite you to email us your questions in advance of future calls as well so that your voice can be heard on these calls. Peter, I'll pass it over to you.
Thanks, Justin. For our economic updates, we utilize research that is compiled by J.P. Morgan Asset Management Guide to the Markets. For those of you assessing by this presentation from your computer, you have access to the videos that we're referencing. The big change over the past few months that has created the stir in the market is the significant drop in the price of oil from over $100 a barrel to just under $61 in April. The cause of this change can be found by examining the global supply and demand and the economic forces affecting it. Very simply, oil production has outpaced oil consumption, and therefore supply has exceeded demand, and this has led to a buildup in inventories of oil. The United States has been responsible for the fastest supply growth in the world since 2013, increasing at nearly 20% annually. And meanwhile, the consumption in the United States only grew by 2.1%. So inventories are built up has meant that the price would eventually have to adjust to allow for the supply and demand to normalize and inventories brought back to lower levels. This is what's caused the price of oil to be lower in recent months. What happens next goes back to the principles of supply and demand. If oil production declines around the world and global demand growth picks up, then oil prices will eventually move higher. If the current demand trends persist and oil remains robust, more robust than oil prices, this prices could move down further. So we feel the long-term opportunity has been created and is twofold in our opinion. The first opportunity that we see is that the drop in oil prices brought down the price of gasoline in the U.S. and around the world. Simply put, people are paying less at the pump. These dollars are considered disposable income and could have an impact on spending in other parts of the economy. Because the money is not being spent on fuel, it is likely that the money will stimulate other parts of the U.S. and world economy. The second opportunity that we see exists where the problem lies: energy itself. This sector saw significant price shifts in many companies when the price of oil adjusted earlier this year, and has been the slowest growing sector of the Standard & Poor's index since the market low of 2009. We see a lot of value opportunities in the energy sector today and feel there are many strong companies that are trading at a reasonable or discounted prices with terrific management teams at the helm to navigate an uncertainty in the short term. We've been focusing a lot of our adding to our positions in the energy sector because of these recent events. Justin?
So, investment highlight that we wanted to bring to your attention on this call is the increase of many dividends for the companies that we own. We are looking at a screen that just shows a number of positions that we own across the portfolios that we manage that experienced dividend increases just this year in 2015 so far. When we meet for our next review, we'll be conducting a dividend increase review for your specific portfolio to point out what has happened to the income stream of your portfolio from last year to this year. Many of the companies that we own have done a fantastic job at increasing the income that is paid to you, the shareholder, year over year. This becomes especially important when you're in your retirement years, where our main focus is in planning for your portfolio to create an income stream that outpaces inflation. Current inflation, if we look at it measured by core consumer price index, today is at 1.8%. We would like to see our investments grow an income stream to you at least 2 to 3 times that. If you can see our visual, you'll see that many of the staples of our longer term portfolios have increased the dividend significantly more than inflation. Amgen, the biotech company, increased their dividend from $2.44 to $3.16, or a 29.5% increase in March 2015. Corning, the glass company, increased their dividend from 76 cents to 84 cents, or a 20% increase in March 2015 as well. So if we align you with investments that are growing your income stream in excess of inflation, we will have created a lifestyle sustaining income stream from your investments. We think it's important to note that many of the investments that we own are not the highest dividend payers available when we purchase them. We're trying to find opportunities where companies have a dividend and have opportunity to increase that dividend based on their earnings. Many of the highest paying dividend companies pay out a dividend that just about equals the earnings per share of the company. We would ideally like the dividend to be much lower than the earnings per share so that there is room to grow the dividend. Additionally, if we buy companies that have a demonstrated opportunity to grow their earnings, there will be more room for dividend growth. The slide that we have shown, for those of you listening online, shows just the companies in our portfolio that announced increases to their dividends this year. We will conduct a review for your specific portfolio that highlights the dividend increases that you experienced in our next review meeting with you. Next, we want to review our investment philosophy. Many of you know and have heard this time and time again, but we follow a strict 3-tenet approach to owning investments. But when we make a decision to buy an investment, it must meet all 3 criteria, otherwise we don't consider it. First, we only own companies that have strong finances and are long-term creditworthy. What this basically means is that we have no interest in taking the risk of going out of business. We know that market conditions can change and that from time to time, individual companies can experience problems. However, if they have a rock-solid balance sheet and are not over-leveraged, there is little risk to the company losing its entire value. Additionally, when markets drop, other companies that are over-leveraged or poorly financed may be forced to sell off assets at what we would call fire sale prices. If our companies have good cash reserves or access to credit, they are often in great positions to buy those assets at discount prices when those other companies are being forced to sell. Second, and again with price, we want to buy investments that are at discount prices or prices that are reasonable to what the company is worth. This criteria comes in all different shapes and sizes and in varying degrees, and sometimes it's actually the hardest metric to measure. Depending on the type of company and what business they're in, the discount might be found by looking at a different angle of the company. Some sectors pay higher prices for future earnings than others, for instance. So we have to evaluate the company, its peers, its history, in order to best understand what type of a discount we are getting when we make the purchase. We'll give you a definite example of this when Peter reviews Lowe's Corporation. Finally, we look for companies that we feel will grow as a business by 10% or more each year. Specifically, we're looking at how the business is being managed. We need to understand how the company will grow in order to feel confident that our decision to buy the company makes sense. Like evaluating the relative price of the stock, finding the growth of a business can come from viewing the company at many different angles. So, Peter, let's take a look at Lowe's Corporation to better understand how we utilize these principles to evaluate our investment decision.
Sure. Thanks, Justin. Lowe's Corporation is a diversified investment company based in New York City. The company has 3 publicly traded businesses and 2 wholly owned subsidiaries. We began purchasing Lowe's in January of this year, and we like the company because it meets the 3 tenets that we just laid out. First, the company is in strong financial shape. The company trades at $40 per share, and that there's $9 per share in cash. Additionally, they have cash flows of $5.50 per share from their operation, so the company trades at about 7 times cash flow. Secondly, we believe the shares are currently cheap. The stock trades at $40 a share, and if we look at the main holdings of the company, we get the following. Excuse me. $24 worth of stock in CNA Financial, a leading personal insurance company. $10 worth of cash and investments in their subsidiaries, net of debt. $8 worth of Diamond Shamrock, a deepwater driller of oil and natural gas. That totals $42 per share. At current prices, the wholly owned subsidiaries of Lowe's, the hotels cost us nothing for 22 luxury hotel properties. Although it's unlikely that Lowe's would spin off those holdings to shareholders anytime soon, if they were to do so, we believe we'd be receiving over $50 in value per share. Having paid just $40 per share in price, we feel these shares are available at a clear discount to the fair value of the assets of the company. Third, we picked Lowe's because it is very well managed. The company has lots of excess cash and is buying back stock. Not only are the shares currently cheap, if the buybacks of the stock continue, it will cause the per share value of the remaining shares to compound at a satisfactory rate of over 10% per year, even if the underlying businesses just muddle along. As of the end of March 2015, Lowe's had repurchased $71 million of stock in 2015, and additionally, they bought back $24 million of stock in Diamond Offshore. Lowe's is run by the Tisch family, and the business has been around for nearly 70 years. Those of you viewing the presentation see a picture of James, Jonathan, and Andrew Tisch, who currently run the company. These managers have a tremendous record of creating value for shareholders and being shareholder friendly. While the Tisch family is at the helm, we expect Lowe's to continue to generate satisfactory returns for shareholders. This takes care of the business end of our call. Now we want to move to the question and answer portion of the call.
Thanks, Peter. We'll be reviewing 3 specific questions that were submitted to us prior to today's call. Just as a reminder, if you have a question that you would like us to review in next quarter's call, please send it to any member of our team in advance of the call so that we can prepare our response. Our first question has to do with the current price of the market. The question is, stock prices measured by the S&P 500 index are at all-time highs. Should we be selling off now to prepare for a decline in prices? To answer this question, we feel we have to first mention that price is only one measurement of a stock. And while we feel it's an important metric, it does not tell us everything we need to know about that stock. The observation made is accurate. The S&P is trading at all-time high prices. But there are 9 sectors within the Standard & Poor's Index, and certain sectors are now not only at high prices, but they're also trading expensively relative to their historic earnings, cash flows, book values. And the one that's jumping out, or the two that we see jumping out, are healthcare and technology, as sectors that are particularly expensive. People are paying premium prices to own those assets. Whereas if we look at the sectors like energy and industrials, we actually feel that prices are much more attractive from a value perspective. So to say that the whole index is highly priced is not examining the entire story. In addition to that, the S&P 500 is only the 500 largest companies listed on the New York Stock Exchange and the NASDAQ. These are exclusively U.S. stock companies, and today most of the world's wealth is held outside of the United States. So while we agree that the S&P index is at high prices, we feel that there is some market risk to owning the index outright. But we don't really feel that continuing to own U.S. stocks makes or discontinuing to own U.S. stocks makes sense. If we dial into sectors where values are good, we're still very comfortable owning U.S. stocks. Actually, our second question dovetails off the response to the first question. The question is, international holdings, specifically mutual funds in my portfolio, have not performed well. Why do we continue to own and add to these positions? So Peter, I'll pass it over to you.
First, let me reiterate the point that we made in the last answer. The lion's share of wealth exists outside the United States. And it's not always been that way, though. The U.S. dominated for many decades, and only in recent decades have businesses in other parts of the world grown to surpass the value of the businesses in the United States. The answer to why international companies have not performed well is complex. We can point to many areas, but a broad answer is that the U.S. dollar has strengthened and foreign markets have not fully recovered. We saw the efforts of the strengthening dollar, especially at the end of 2014 and in 2015. Specific to the mutual fund performance, I feel it's most appropriate to review this in the personal meetings because everyone's experience is different. When evaluating a mutual fund's performance, we can't just look at the price paid for the fund and the current price to determine the total rate of return. As many international funds that we own in particular have paid significant capital gains, and whether you reinvest those or have those paid in cash, they're still part of your total return of the investment. And if you think this is something you'd like us to review in your next meeting, please let us know so we can go over your statement with you. We still want to continue to own international investments, and we have been introducing new international companies to most of our portfolios. The reason we like international is because we are still able to find gems that no longer exist in the United States. There are many great financial strong businesses at discount prices available at international markets. As we sell out of some of the highly appreciated U.S. sectors, it's likely that we'll continue to add to the international stocks. A third question is about the future opportunity. Are there any areas that you feel to invest in that are newer businesses that will experience high growth? We spend a lot of time talking about our value philosophy and harping on the reasons for owning mature companies at the right price. This doesn't mean that we aren't looking for growth opportunities, though, and we like to own a lot of companies in the growth sector that we feel can be purchased at reasonable prices. Two that come to mind are NVIDIA and Corning. NVIDIA is a California-based company that dominates virtual and visual computing. The company has been around since 1993, and they have a number of exciting opportunities with their businesses. They dominate the market in the gaming technology for the gaming processing units, where they have 72% market share, where they compete against both Intel and Advanced Micro Devices. As a matter of fact, Intel pays them licensing fees for the use of their technology. Their closest competitor, Advanced Micro Devices, unfortunately, or fortunately for us as shareholders, is in very poor financial shape. As opportunities come along, I don't believe that they're going to have nearly this same element of opportunity that NVIDIA does to take advantage of those opportunities. NVIDIA has done a marvelous job with the business, and they have aggressively put money back into research and development, much as Corning does. About 30% of their revenues go back into research and development. The company trades at about $22 a share, and during the first quarter of this year, NVIDIA paid $46 million in cash dividend and repurchased 2.4 million shares. So as a result, they've an aggregate of $99 million has been returned to shareholders. They also plan to increase their dividend by 15%, during the 2015 fiscal year, they plan on returning about $800 million to shareholders, either through cash dividends or share repurchases. One of the very exciting areas that we see with NVIDIA is the self-driving cars and the visual technology that NVIDIA can provide that has the deep opportunity for deep learning in the environment that it's looking at has a tremendous opportunity. They have agreements with Audi, BMW, and Tesla at the moment, and it looks to be a significant growth opportunity into the future. Corning, while it's a company that's been around since 1850, continues to have many terrific growth opportunities. We attended their annual meeting last month with about 20 of our clients who are shareholders in the company, we were very impressed with what we heard from the managers of that business. First of all, we feel the company is in extremely strong financial shape. They've put a significant amount of money in research and development, and they've been very shareholder friendly with a 20% increase in their dividend, as we discussed in the dividend review earlier. The opportunity for the Gorilla Glass and the cover glass that's used in millions of devices throughout the world continues to have strong opportunity, as well as fiber optics and large screen glass for the television markets as well, and computing markets as well. So those are some of the opportunities that we feel are available. Justin?
This concludes the June 2nd, 2015 O'Keefe & Stevens quarterly update call. This call is going to be archived in our library, and you can request this call in an email format just by emailing any members of the O'Keefe & Stevens team. Please look out for the date of our next time for the quarterly call in the summer edition of the Value Connection newsletter. We welcome your questions and comments in advance of the call so that we can prepare our responses. Thanks again for your time today, and have a great afternoon. I'm going to be turning off the recording now, and we'll open up the lines for just some discussion. Thank you.